Hi everyone, this is Alessio Rostoni of leadingtrader.com. Now, this is going to be a controversial video and you'll see why in a few moments. What I'm looking at is the chart of one of the most hated stock markets and probably one of the most unpopular stock markets in Europe and maybe even in the world. And you'll see why in a few moments, why I say hated. But first of all, let's have a look at this market from a technical perspective, and then we'll have a look at it from a fundamental perspective as well. From a technical standpoint, we can see that this market has been a tremendous downtrend from the crash of 2008, and then you can see we bottomed out in 2009 here, and we actually didn't really make much of a recovery since then either. Now, having looked at this, we can see that, just do a trend line analysis here, you can see that we've managed to break, we just connect these highs, these tops. So recently this market managed to break through this particular resistance trend line here, this resistance level. So it managed to break through that, then come back here and retest it. So you can see that it came back to retest that trend line, almost retested it, and then managed to kiss it goodbye and then rally from there, which is a good bullish signal and a confirmation of a trend line break. Now, apart from that, we can also see that we have, I wonder if you can guess which particular reversal pattern that we can see here. Now, fans of technical analysis will know that what we have here is a bullish reverse head and shoulders pattern. Okay, so this is the head, that's the left shoulder here, and that's the right shoulder. Should probably do that a little better. And that's the right shoulder here. Okay, so left shoulder, right shoulder, and the head is here. Okay. Now, there are three things I quite like about this head and shoulders pattern that you see here. And the first thing really is that it's a high probability, so it's a high probability bullish reversal pattern. Number two, we formed a higher low. Okay, so we had this low here, and then we formed a higher low, which is also the first sign of the beginning of an uptrend. So higher low. And number three, we formed this head and shoulders pattern you see here near support, okay, near the previous lows back in 2009, okay, so near major support. All right, so that's three things I quite like from a technical perspective. And of course, we've got a break of resistance here, this trend line here as well. Now, there are other things I quite like about this particular market is, let me show you this from a fundamental perspective. So what I'm showing to you here is a table of different countries and their PE ratios, which you can see being shown to you on the right-hand side. Okay, so the PE ratio, by the way, for those of you not familiar with this term, is a measure of valuation. Okay, so this is how typically we value, so it's a valuation of different markets or stocks. And typically the lower the PE ratio, okay, so the lower the PE ratio is, the better it is as well. And the best way to do this is really compare the PE ratios next to its competitors. Now let me ask you this. Out of all these countries you see here in Europe, all right, actually they're not all in Europe, but some of them are, most of them are. Out of all these countries, which of these countries has the lowest PE ratio? I wonder if you can spot that out quickly straight away. Yes, you'd be correct if you said Italy, all right? So Italy has a PE ratio of 9.32. I mean, the closest one that actually comes to Italy, as far as one of the major European countries is concerned, is probably Spain, as you can see here, okay? And you can see that compared to Ireland, I mean, Ireland still remains pretty expensive, even at 18 PE ratio here, okay? So from a fundamental perspective, certainly Italy appears to be undervalued and cheap. But of course, remember, we never just buy into a market or a stock just because it is undervalued or cheap. We always wait for a reversal signal. So as you can see here, certainly from a fundamental perspective, it appears that Italy is bottoming out and forming a reversal pattern. Now, okay, so you can see that what we're looking at here right now is the ETF for Italy. As you can see, there's Italy up here, and EWI is the ETF for the Italian stock market. Of course, you don't have to do the ETF for the Italian market. You can just go on the index and trade the index instead. Now, my guess is that some people who are watching this video are going to be screaming at me and saying, you've got to be insane if you're thinking about buying Italy right now. I remember I had a chat with a good friend of mine about Italy only about a few days ago, and he was telling the same thing to me. Alessio, why would you want to buy Italy? Nobody is interested in buying Italian stocks right now. And that is exactly my point. Remember, folks, as professional investors, okay, as professionals, we want to get into the market when nobody wants it, okay, when nobody is interested. Does that make sense? The worst thing that investors do is they get into a market and buy stocks that everybody else wants, that the masses want. To invest or trade successfully, we must do the psychologically impossible. Okay. In other words, buy when nobody else is interested in buying and sell when everybody's excited with greed. All right. So right now, Italian markets, most European markets are hated, but certainly from the valuations we've seen so far from a fundamental and technical perspective, Italy, in my view, is the best candidate out of the European countries. So certainly right now, Italian stocks are hated. They are unpopular. And that is also what makes it so attractive to me and professional investors. One of the biggest mistakes people make when it comes to investing in the markets is they say or think things like, oh, but hang on a second here, the GDP is awful in this country or in this market, or the unemployment numbers are just terrible. And you look at it, we're in a recession, so recession and things like that, and interest rates, housing is terrible, and all that kind of stuff. But listen, the great professionals, all the great important investors out there like Warren Buffett, Peter Lynch will tell you that none of this stuff about GDP unemployment will tell you about what the stock market will do next. All right? The biggest mistake people make is that they think all these figures about GDP unemployment will tell them where the stock market will go next from there on. Remember, the stock market is forward thinking. It's based on expectations. You can sit in front of your TV or listen to the radio and newspapers, and all they'll say is give you negative stuff, all kind of negative views about the economy. But the stock market will do its own thing. The stock market does not reflect what's happening right now or what's already happened, but what the insiders, what the smart money is thinking about the markets 6 to 12 months down the line. All right. Remember, it's based on expectations. If the smart money thinks that it's a good time to buy, that it's undervalued and cheap, then they'll buy. All right. So don't get caught up on all this nonsense about GDP and unemployment. Let me just show you an example of what I mean. Have a look at, for example, just have a look at the S&Ps, for example. Actually, look at the Dow. It's probably a better idea. The Dow has been one of the strongest markets in the last four or 5 years. I said back in 2009 that I was buying stocks. I was going long on stocks. And I remember at that point, there are many people who were angry about what I said. Oh, are you kidding me? Why would you want to buy stocks when the GDP is bad and, we got unemployment numbers are really bad and recessions going on here? But look, those people who were thinking about what's happening, the people who were listening to the news on the television channels and the radio, they would have missed out on this great trending opportunity, this great buy opportunity in stock markets. All you ever hear in the UK about the economy is all negative stuff. Oh, negative GDP and recession and depression, that kind of stuff. But look, the UK market just managed to make a new high. Remember this phrase from Peter Lynch, by the way, when he said, Peter Lynch, by the way, one of the most famous and important money managers and investors in America. He said, if you spend 13 minutes thinking about economic forecast, you wasted 10 minutes. So bottom line is, don't get caught up in all that nonsense about GDP and unemployment numbers. Honestly, those things will not tell you anything about where the stock market is going to go. As professionals, we need to position ourselves in the markets before everybody else gets interested in it. We don't necessarily have to buy it right now. We can actually wait for a pullback. Say a pullback to this is a weekly chart I'm looking at here, so pull back to the 21 period moving average, or maybe a retest of its previous lows here near 12, or whatever previous lows you're looking at on your chart of the Italian markets. All right. The other thing, by the way, also notice how close we are to support. So the support is here around about 9. So if you bought here about 12 and support is about 9.5. Okay, your risk reward is actually pretty good. You're risking you're risking 3 points to make potentially, so reward, potentially 8 to 10 points. Actually, probably more than that. It's unlimited. All right, let me just show you what I mean by that. If we just zoom back a little bit here, all right, you can see if we do a Fibonacci retracement from the highs here all the way down to the lows in 2009, okay, even if the Italian stock markets manage to rally back to the, okay, let's go here, to that 38.2 retracement, which puts it at 19 and 0.8 or $20 basically we're looking at here, okay? That's still pretty good. So I mean, you're risking 3 points to make potentially 8 points, okay? So if we rally from 12 to say $20. Of course, if it goes to the 50% retracement, okay, that's at $23. So essentially you're risking 3 points to make 10 points here. Now, I'm not saying it's going to go there very quickly. This might take 6 to 12 months to get there. Bottom line though, from an investing perspective, I do have, what we have here, remember, what we have here is small risk, but a potentially unlimited reward. Okay? To trade or invest in the Italian stock market, you can just go on ETX Capital, which is the brokerage we recommend, and you go on this platform and just look for indices on the left-hand side, and then you select Euro indices. Okay, just go down the list here, look for Italy 40. So you can do either Italy 40 CFDs or you can invest in Italy 40 futures. Okay, either one is good. I personally prefer the Italy 40 futures. And you can do this with CFDs, contracts for difference, or spread betting, whichever you prefer. Hope this helps. I wish you good investing. Bye for now. Alright guys, I hope this video was useful to you. Let me know your own views about what I said in this video about my analysis, and I would look forward to reading your comments. All you got to do is go on this link you see here, which is leadingtrader.com/Italy. Okay, so /Italy. Go there, that's my blog, and just go ahead and leave me your comment below the video.